Welcome to Sales Accelerators, Winning Strategies for Financial Professionals, an educational webinar series that explores the latest tools and concepts to help boost your sales performance and drive business growth. Join us as we analyze trending topics in life insurance, investigate the latest headlines, and discuss solutions to accommodate your clients' unique needs. Please welcome your host, Kurt Fazen, Executive Vice President of Sales and Marketing.
Hello, and welcome to another edition of Sales Accelerators. My name is Kurt Fazen, Executive Vice President here at DBS, and today we're going to talk about the foreign national market. You know, this market has continued to grow and grow since the 1970s. And while foreign nationals often face some financial challenges, it's these challenges that actually open the door to some innovative life insurance planning solutions. Today, I've asked our dear friend, Vicente Pena from Prudential to join us. He is the Director of Advanced Planning, and he brings with him more than 35 years of experience to this conversation. Now, his primary focus at Prudential is life insurance strategies, and those specifically akin to the ultra affluent, the high net worth, and the foreign national clients, making him an invaluable resource for today's discussion. Thank you for joining us today.
Thank you, Kurt, and thank you, DBS, for inviting me. And hopefully today we'll have a very impactful session. So what I'm going to do now is I'm going to share my screen and we'll get right into it. So let's talk about the foreign national market. As you said, Kurt, it's a very kind of dynamic and growing market. And we're going to go through different aspects of it, what the definition of a foreign national market is, and what are the ways that we can address that market knowing that it is a growing market and they have needs for life insurance. So let's get right into it. We have our typical compliance slide here, but now let's get into our agenda. 3 simple things: who are foreign nationals, why they need to plan, and where life insurance fits in. So let's start off with who are foreign nationals. A foreign national is a type of alien. What we mean by an alien is they simply were not born in the U.S. So some people call it non-U.S. citizens, would be another way to say alien. And within the alien or the non-U.S. citizens, there are 2 types. There's the type called the resident alien. That means they were born elsewhere outside the U.S., but they live here in America full time. The other type is the person who was born outside of the U.S., but they come to the U.S. periodically, maybe for business, maybe they have family, maybe they have real estate or perhaps investments. Maybe they went to college here, but they return to their home country and they're domiciled there, but they come to the U.S. maybe, a month, 2, 3 a year, maybe less, maybe more. But the point is they're not domiciled here. So that's the big distinction between the resident alien and the non-resident alien. The resident alien was born outside of the U.S., but now lives here full time. The non-resident alien was born outside of the U.S., and they only come here to visit for a little bit of work, but they don't primarily reside here. Their domicile is in another country.
Makes sense.
When we talk about resident aliens, as I said, they're a non-U.S. citizen, but they live here. So, Kurt, let's just say you have a prospect or a client, and maybe they're recruited to a big company, maybe Target or Boeing or whatever, and they're recruited to work here in the U.S. So they were born maybe in Asia or Europe or Latin America. Maybe they went to college here or they were recruited, and now they come and they're going to live in Minneapolis or Chicago or Los Angeles or whatever. But they're still a citizen of that home country, right? They're just living here, working here. Maybe they have a home and children and cars and 401ks and a house and all of that, but they're still a citizen of that other country. So they're here full time, working here full time, but they just haven't switched their citizenship. Maybe they're not interested in switching their citizenship to the U.S. And there's plenty of examples of folks like that who are non-U.S. citizens living in the U.S. for an extended period of time, or forever for that matter. There's no requirement that they become a U.S. citizen. So you might be thinking to yourself, well, this looks a lot like me and you, right, Kurt? I mean, they live here. right? They
Yeah.
live in Minneapolis, they own a home or, and they have a job. Well, why aren't we, talking to them? Well, sometimes, um, you know, uh, producers, agents, brokers are a little bit reluctant to approach these people because they don't know if they're familiar with insurance. Maybe their country doesn't really emphasize insurance. So maybe they're like reluctant. Maybe they see them walking around the neighborhood and they're like, well, I don't know. I don't know them. I don't have the background with them. Maybe they're from India or they're from China or they're from France or Sweden or whatever the case may be. And I just don't know them that well. And I don't know their background. So I'm not going to ask them. The reality, Kurt, most resident aliens have the same needs you and I have, right?
Mhm.
They want to protect their homes and their families and their children and their spouses. They want mortgage protection. They want college funding. They want all of those things, just like we do. The only difference is they were born in a different country.
Yeah.
So
Makes sense.
moving on, we talked, I alluded earlier to the domicile versus residence. Your domicile is where your fixed and permanent home is, right? It's where your home base is, right? You can only have one domicile where all of your, your major stuff is. You might have a home in the U.S., you might have a home in the mountains, at the lake, at the shore, but that's just a secondary residence. And so many people have a second residence, but your domicile is your domicile, which is really your fixed and permanent home. So in this case of a resident alien, their fixed and permanent home is the USA. And that's one of the reasons why at Prudential, we write resident aliens just like people like you and me. There's no hoops you have to go through. There's no issues or obstacles. You can write that application, Kurt, today on that resident alien that lives down the street from you. You can write that application today.
That's
Nothing
awesome.
special you have to do.
Yeah, that's great.
That is great, isn't it? We always think that maybe there's something special about resident aliens. From an underwriting perspective, we like that business because all of their information is here, right? Their driver
Mhm.
information is here, their finances are here, their doctor is here, their pharmacy is here. So resident alien is easy business for Prudential. Now, I'm not going to spend a lot of time on resident aliens because now we know it's easy business. But in case, individuals watching this video want to know, what constitutes a domicile, you have all these factors here, right? These are all things that the government considers to determine your domicile. And the easiest thing for them to do is they can tell through your travel when you go in and out of the country how long you're here. So if you're here 365 days and you haven't left the country, then they pretty much will assume that your domicile is here, particularly the longer you're here. But if you have people who split time, maybe 50-50 or 60-40, they look at these factors. So for the most part, what we see as resident aliens are here in the U.S. a majority of the time. So we don't really need to go into that much depth because the application will have their local U.S. address on it, and of course their local employer and all those things. So it's pretty self-evident that these folks are U.S. resident aliens. Now you might be asking yourself, why do foreign nationals need to plan? Well, one thing is that their assets may be subject to U.S. taxation. What I really mean by that is federal and sometimes state estate tax. So being a resident alien, Kurt, is a mixed bag, right? On the one hand, you get to enjoy all the benefits of living in the U.S., right? On the flip side, you have to deal with the U.S. tax system. And as you know, that's probably something that we all wish was a little easier to understand. But suffice it to say that a resident alien, their estate tax from the federal level is based on their worldwide assets. So think about it, Kurt. Let's just say you and your family have a home in Europe. Maybe you inherited from your grandparents, and you and your wife go there maybe, once a year, twice a year to, visit family, maybe go skiing, or maybe it's down by the Mediterranean. But, you pretty much live in the greater Minneapolis area, but you go there in the summer and you spend a few weeks. Well, you're a resident alien. Guess what? That home in Europe is going to be included in your estate for estate tax purposes. So bear that in mind when you're a resident alien. Even though you're not a U.S. citizen, you're a resident alien, you're living in the U.S. full time, you are going to be taxed on your worldwide assets.
Wow.
So that's a big takeaway. And I bet you most resident aliens don't know that.
Yeah, that's great.
Secondarily, as I mentioned earlier, they have the same needs that we have. They want to cover their mortgage. They want to send their kids to college. They want to provide salary continuation. They have all the other needs that the rest of us have. So, there are opportunities to sell term insurance, permanent insurance, second to die, VUL, IUL, all the products, because they have all the similar needs that everyone else has. Of course, if they're higher net worth, then we're going to have that conversation around U.S. estate taxes.
Mm-hmm.
So just kind of closing the loop on the resident aliens, we know that the tax rules from resident aliens are virtually the same for U.S. citizens, right? You and I, Kurt, are U.S. citizens, so we're subject to U.S. estate tax. We're subject to gift tax, the GST, as well as the annual gift tax exclusion. Now, if you're married to a non-resident or non-citizen spouse, that's where it gets tricky. So let's look at an example. Let's say, Kurt, I was married to a woman and she's a non-citizen, which I actually had this experience. My wife was born in Chile, came to the United States in the 80s, and has been here ever since. She goes back to Chile to visit her family, but she was a non-citizen residing in the USA. Well, those gifts are limited because she's a non-citizen spouse. So there's a little bit of a nuance there. 190,000 is what she can gift per year for a non-resident spouse. Other than that, they're pretty much the same as U.S. citizens.
Got it.
Now, we talked a little bit earlier about the marital deduction, meaning, you can transfer things between U.S. citizen spouses. That exists for U.S. citizens. But when it's a non-citizen spouse, in that example of my wife being a Chilean citizen, but not a U.S. citizen, there are limits to those transfers, and it's usually achieved by using what's called a qualified domestic trust. A qualified domestic trust will allow those unlimited transfers to happen between me and my non-citizen spouse. What I find, though, is that a lot of the times the non-citizen spouse is waiting to become a U.S. citizen. In the case of my wife, that's exactly what happened, is she eventually became a U.S. citizen and decided that there were more benefits for her to become a U.S. citizen than remaining a non-U.S. citizen. The lifetime exemption is still 13.9 million, which is the same, Kurt, for me and you, right? And it'll be going up with the big, beautiful bill to 15 million come January 1st, 2026. And then there's gift splitting that is available for both spouses if they're U.S. citizen or resident aliens.
Okay.
So as you can see, there's not much difference between resident alien U.S. citizens. So I think the big takeaway for our audience, Kurt, is if you have clients that are resident aliens, meaning they were born elsewhere, but they live here full time, have at it. 100%. That business is easy business. You can write that application today.
Well, and what I want to say really quick is all of you, when you signed up for this session today, you received your Sales Accelerator action form. And that's really something for you to be jotting down as you're hearing this, clients that would make sense. So you've got your first takeaway. Let's start getting some of those names in there so we can help you with that. So let's move to our next spot.
Yeah, our next spot, Kurt, is the non-resident alien. Again, this is the person who's a non-U.S. citizen. Again, they're an alien. They're born outside the U.S., but they also domiciled outside of the U.S. So they'll come to America for vacation. They'll come to America. Maybe they have a business here that they come and they check on. They might have relatives here. Maybe they have in-laws, grandchildren. Where I live, there's a couple right in our cul-de-sac. She's an American. He's French. They have 3 children. So, of course, they go to France. They visit the grandparents. They're going to visit the uncles and the aunts. And then the grandparents come and visit here. Now, if they wanted to buy life insurance, they could. And hopefully they'd buy it from DBS. But there's a few requirements in order for them to do that. So the first thing is thinking about the non-resident alien. What are some of the subtle differences between, the tax structure and why they might be buying insurance? So, if they have U.S. property that's owned by, the non-citizen or the non-resident alien, there's going to be tax implications there. So there are more differences between the non-resident alien and the resident alien when it comes to the estate tax. Now, the good news is if you're a non-resident alien, Kurt, they're not going to tax that home in France because you're a non-resident, but they will tax or include in your taxable estate your assets in the U.S. So let's say those grandparents bought a house here where I live and they want to be closer to their grandchildren. Well, they're going to own a property here in the U.S. Well, that property is going to be included in their taxable estate.
Sure.
Now, we're going to see in a moment, the U.S. estate tax system is not so favorable for non-resident aliens. The exemption is only $60,000.
Wow.
So that's a pretty low number. So.
Ooh.
I'll show you a visual of that in a moment. I'll finish up this slide by saying that the U.S. gift tax is also different. Well, I'm going to show you an example of that. The GST is also different, and their annual gift tax exclusion. They can still do the $19,000, but there are some limits on the non-citizen spouse, and there's also differences in terms of the non-resident alien. So I'm going to switch our documents here for a moment, and I'm going to pull up a document that is called our Prudential Guide to Life Insurance for U.S. Residents and Foreign Nationals. So this is kind of our playbook for this market. The previous document we talked about is a PowerPoint. It's more developed to educate the advisor. Here, this is more of a shorter document that goes into more depth as to why they want to buy life insurance. So we're going to get right into it. You mentioned, Kurt, about the foreign-born population. It's over 18 million children under 18 who will live with at least one immigrant parent. That's like 1 in 4 children under 18 in the U.S. have one immigrant parent. As I said, in my neighborhood, we've got this French guy married an American woman, and over here on the other side, I have an American guy from Minnesota married a Colombian woman. They have 2 kids. They're, the in-laws on one side are in Minnesota, the other in-laws on the other side are in Colombia. We have another couple over here, and he's an American and she's from the Philippines. So it's all around us. I think we just, as advisors, maybe think, well, I don't know anything about the Philippines, or I don't know anything about Colombia or France, so I'm not going to bring up finances with them, but they have the same needs that you and I have. So I'm going to just mention quickly our needs that we talked about. They have the same needs, both non-resident and resident aliens. They have this income replacement, salary continuation, legacy for heirs, college funding. They want the same things that we all have. If something happens to the one of the parents, they want to be able to provide so that the family can continue. But the big one here for certain high net worth people are the estate tax liabilities. So I'm going to just skip down to another page on here, which is going to be, I believe, page 10. I went one page too far, and I'm going to scroll down to the summary of estate tax and gift differences. So on the top here, Kurt, we see the classic U.S. citizen married to the U.S. citizen. So now that my wife is a U.S. citizen, we got U.S. citizen to U.S. citizen. The exemption today, $13.9 million, unlimited marital deduction. So, all of our assets, we don't have to worry about gifting, anything that's hers when she dies becomes mine, and vice versa. So it's pretty seamless. There's an assumed 100% interest, 50% interest in both properties that's jointly held. So if our checking account, it assumes that we're 50-50 there, unlimited gift tax, marital deduction, and of course, gift splitting and gift tax exclusion. So this is your classic U.S. citizen scenario. There are some subtleties here, Kurt. Like, let's say you're married to a resident alien. Well, you notice you get the exemption of 13.9, but you don't get the estate tax marital deduction. And that's where this qualified domestic trust comes in place. And I'll talk about that a little bit in a moment. A SLAT, or an irrevocable trust with the spousal lifetime provisions is a good substitute for the QDOT. But you can see there are some differences here. It's assumed that the decedent's interest in the property held with is joint with the spouse, it's 100% attributable to the U.S. citizen. There's only $190,000 a year gift tax exclusion. So if I wanted to make a large gift to a resident alien, I do have some limits there. But what I want to really do is I want to scroll down to these combination of these others. So let's just say hypothetically, this is probably not common, but you're a U.S. citizen married to someone who's a non-resident alien. So that would mean that this person is not living here and they're not a U.S. citizen, and I'm married to them. Now, it's possible, probably not highly likely, because we wouldn't be really spending a lot of time together. This is presuming that I'm living here and the non-resident alien is living outside of the country. But probably what's more common is a resident alien married to a U.S. citizen. That was my situation for many years. Or you have two resident aliens, right? Two people who just decided not to become U.S. citizens. There's no requirement for people to become a U.S. citizen. When they're here permanent, then they're here permanently. And so they're considered resident aliens. But when you get down to the non-resident aliens, that's where, Kurt, it gets particularly onerous for the non-resident, because that's 60,000.
Yeah. Ooh,
that's pretty low.
That's amazing. Yeah.
Isn't that? I mean, you could buy a car in Minnesota, in Chicago, in the US, anywhere, and that car will almost put you into an estate tax problem if you're a non-resident alien.
100%. Absolutely.
100%. And so you imagine a non-resident might say, listen, I like to have a place in Florida because in the winter, maybe I'm in Europe and I like Florida and I like going there when it's cold where I am. I go down maybe in January, February, March, and maybe I buy a place. My wife and I buy a place in Florida or Arizona, and it's nice and warm there. We're only going to be there for a month or 2 or 3. We bring the kids. Well, that house alone is going to create an estate tax issue because of that $60,000 exemption amount.
You bet.
So another big takeaway here is the non-resident is the person who comes here periodically, but they own assets in the USA. Now, this estate tax that we're talking about, this exemption 60,000, only applies, Kurt, to their assets in the US. It's not going to include that house in France or that place in, Japan or that place in South America. That's not going to include anything that they have in the US would be included, the stuff outside. So it's a little bit of a trade-off when you go from being a non-resident to a resident, and that is the non-resident will be taxed on their assets in the U.S. and the $60,000 exemption. The resident alien will be taxed on their worldwide assets, but they do have this larger exemption of the $13.9 million.
Yeah. Okay, well, that makes sense. Wow,
does,
what an opportunity though. What an opportunity though for the non-resident alien. So those of you that are keeping track on your action sheet, boy, there's 60,000. I mean, there's so much. I can think of thousands of examples of how that could be a problem very quickly.
Well, Kurt, I mean, 60,000 is closer to zero than it is to 13.9 million. So
amen to that.
For all intents and purposes, the non-resident alien who owns anything in the U.S. is going to be subject to estate tax. So the next thing I want to talk about, Kurt, is we've established that what the needs they have. The needs could be, like we said, salary continuation, income replacement, college funding. It could be even estate taxes. That's a need here because of the $60,000 exemption. Or for the case of the resident alien, their worldwide assets. But now I want to talk a little bit about, let's say you're working with this non-resident alien and they tell you, Kurt, I live in XYZ country, and then the red flag goes up because you think, well, gee, that country I've never heard of, or that country seems like a little off the beaten path. It's not like it's, maybe Canada or, a country that we're very familiar with, the UK. But let's say they tell you it's a country that maybe you just feel, I got to do some checking on. So we have another document called our non-US resident guidelines. And much of the information on this first few pages are what we just went through. It kind of reiterates, what they need to do in order to kind of qualify. We go into a little bit more information here. When they're a non-resident, we want to know, a little bit more about why they're buying life insurance. And usually they're buying life insurance because they have this need. And typically the need is, things like a business. You see here U.S. citizenship. They own real estate. They have a tax liability. Sometimes they just want to buy insurance, Kurt, because their home country doesn't have a strong life insurance industry.
Right.
One time I worked in Argentina in the life insurance business, and they having a lot of problems at that time with their currency was devalued, and they defaulted on IMF loans, and so the currency was up and down. And so people will often opt to buy life insurance in the U.S. because they just don't feel confident. Or maybe the face amounts that they can buy in their home country are limited. Maybe they want to buy a $1 million policy, but in their country, a $1 million policy is not permitted. So one of the things that we like to look at is, why are they buying life insurance? Of course, we want to know, what their global net worth is, because we're assuming that if you're a non-resident and you're coming to the U.S. for buying life insurance, you're probably pretty successful, right? You're not coming here to buy a $5,000 burial policy, right? You're coming here because you're successful. So that's why we ask for the global net worth of 2 million. Now, all these nexus, what we call nexus or meaningful tie, I like to use the word meaningful tie better than nexus because not everyone understands that, but the meaningful tie, you can have any one of these. You don't have to have all of them.
Oh,
so
okay.
Let's just say you're a non-resident and you're a U.S. citizen. Say it's you, Kurt, and you get promoted and now you're heading up DBS in Europe. Well, you still have your place in Minnesota, but now you're going to be living in Europe most of the time. Well, guess what? DBS can still write you because you're a U. Now, of course, you got to come back to Minnesota or the U.S. for us to take the application. But the reality is you're a U.S. citizen. So for us, that checks the box. That's easy.
Yeah.
Let's say your spouse is a U.S. citizen or a U.S. resident. Of course, that checks a box. Let's say neither one of those, but you own real estate in the U.S. So you're a European entrepreneur or business owner, and you buy some real estate in the U.S. Maybe you buy that place in Florida we talked about to go on vacation. Maybe you own a business in the U.S. or you're employed by a U.S. company. Maybe you're employed by DBS and you're their head of their operations in Europe. That's fine with us. That proves the nexus, the connection. If you have a U.S. tax liability, we talked about that earlier. Typically, it's some type of a state tax liability. And lastly, if you have ownership of U.S. assets for a minimum of 6 months and equal to 25% of their total net worth, or a minimum of $500,000. We find this particular requirement when they don't have any of the ones above. And again, you only need one of those above. But let's say you don't have any of the above, Kurt. We find sometimes with these folks, maybe they have a brokerage account or an investment account or some type of investment that they've had here, and it's over $500,000. That's an easy one to satisfy. And I think you get the picture here that we're really looking at folks that are a little bit more, higher net worth, right? So for a lot of brokerage accounts, for a lot of investment folks, $500,000 is a really small number. Maybe some of them don't even manage clients with that low an amount, but that's just something to bear in mind.
For sure.
One other thing I wanted to mention before we get into the countries is sometimes advisors will ask, Kurt, they don't have a Social Security number. Wow. Well, good news. We don't require a Social Security number. And there's a couple of reasons for that. Number one, if you're non-resident, why would you be paying into the U.S. Social Security system? Chances are you're going to go back to your home in Europe or Latin America or Asia, and so you don't necessarily have Social Security number. But what you do have is what they call a TIN, a tax ID number. And the most common form of TIN is the form W-8. A W-8 is the kind of a tax ID number you can get. It helps non-residents being able to do business in the U.S., like open bank accounts and get loans and those kinds of things. So most of the time, the non-resident alien doesn't have a Social Security number, but they do have this W-8. And it's usually a W-8 BEN is the most common, but there's a W-8 ECI, EXP, etc. So just be aware. That's not a deal breaker for us, not having a Social Security number. We actually don't expect many non-resident aliens to have a Social Security number, but they must have this TIN, this tax ID number.
Makes sense.
So I'm going to scroll down to the country list here because that's really the kind of third major area that we're going to talk about today, which is you've established that the non-resident market You know that there's that low exemption. Now you want to think about what country do they live in? And so this top A category of countries are countries that, Prudential has determined it's, easy to get medical information. They're usually Western style countries or countries that, have modern medical systems. There aren't war zones or countries that have rules against buying life insurance by its residents. So this top kind of grayish area, and we update this every year and a half, sometimes more frequently. We just updated it in July of 2025. So if you have any clients or prospects in this A category, it's full steam ahead, and you can get preferred best, which is wonderful, right?
That's awesome. Yeah.
That is wonderful. And what we see a lot of is we see a lot of folks from these countries like Brazil, Australia, Hong Kong, Germany, so on and so forth. So these are, the UK, of course, I mentioned them earlier. The B countries are just a little step down where you could still write them, but the highest category you can get from an underwriting perspective is non-smoker plus. And so these countries are, they're a mixed bag. Some of them are kind of smaller island countries. Some of them are South American countries. Some of them are maybe more associated with the Caribbean and vacation places. But the actual bigger category is the mix, because every country is a little bit of everything, right? So think China, for example. There's modern, ultra-modern cities that, would be considered A. They have good health care. They've got, good life expectancy. They have more modern technology. When you start getting outside the metropolitan area, say those second-tier cities, they're considered B. But the rural areas are considered C, and C is not acceptable in terms of you writing them. Colombia is a mix of B and C. You can see Ecuador. India is a rather large country. It's mostly B and C. There's no A in India. And Indonesia, the Jakarta and Bali, the two of the bigger metropolitan locations, are A, and all other parts of Indonesia are B. Mexico is very common. We get a lot of Mexico applications for Mexico. The big cities, you can see a whole list of them there, are considered A, so you can get preferred best. And the remaining areas of Mexico are B, which is pretty good. Yeah. And Peru is the same. The Philippines, the big city is Metro Manila, and they're considered an A region. The remaining areas are C. There's no B regions in the Philippines. And then lastly, you have South Africa, which the big cities, the big major three cities, are A, and all the others are B.
Yep.
What I want to wrap up with today, Kurt, are the countries that are somewhat problematic or we have kind of some issues with. First, you have a type of country in the gray here that they have laws, Kurt, believe it or not, that don't allow its residents to buy life insurance from a non-local company.
Really?
The example that the example we run into a lot is Japan. You'll have a lot of Japanese prospects, and they want to buy life insurance in the U.S. They like the U.S. dollar. They love the fact that that we have large face amounts and so on and so forth. But the government of Japan has basically said, if you're a Japanese resident, you must buy life insurance from a Japanese life insurance company. So that does create some heartache when you have a Japanese prospect who wants to buy insurance from you, and unfortunately we can't. You have these, mix of countries here. I will mention, just as a little call out, this Canada. We can write Canadians, but we can't write VUL on Canadians because VUL in Canada is considered an investment product first and not a life insurance product first, like it is here in the U.S. So if our friends from the north come down to Minneapolis or come down to any part of the U.S. and they need life insurance, you certainly can write them IUL, UL, SUL, SIUL, you name it, but we just can't do VUL with Canadian residents. So that's important. And then lastly are the countries that are basically, I refer to these as no-fly zones. We won't accept them under any circumstances. And these tend, Kurt, to be more problematic countries, right? Think about places like Cuba and Russia and North Korea, in Syria. Those are places, Iran, that we're probably not going to be writing insurance on those residents anytime soon. Now, there is one thing I want to, call out here is Israel. Israel, for the longest time, was an A country, but it became a C with all the issues that it's been having since the invasion and all the things that are happening since. So there may be a day when Israel returns back to either B or an A, but for now, Israel residents who come to the U.S. to buy life insurance, we unfortunately cannot write them. And that's why we update this every year and a half or so. So if things change, this list will change as well.
That's great.
So the last thing I wanted to do is I just wanted to go back to our PowerPoint here, and I wanted to just kind of go back and just talk a little bit about what we can do from here. So we talked about the non-resident aliens. I mentioned that a non-resident alien can get some of the benefits that you and I can get through the use of this qualified domestic trust. Well, a SLAT, and I know, Kurt, you're familiar with the Spousal Lifetime Access Trust, can really duplicate and maybe even eliminate the need for a QDOT, because it allows you to provide the liquidity needed when the non-citizen spouse needs it most. Because in the case of a non-resident alien and they want life insurance, but they're married and they want all the benefits of having that citizen spouse, they want to have those exemptions. A lot of it is more difficult without the use of this QDOT. But with the QDOT, you have some rules that you have to essentially satisfy, including the leverages available to the gift exemption are outside the insured's taxable state. There's indirect access for the spouse beneficiary, so my surviving spouse, indirect access. There's an independent trustee that's involved. Whereas here on the SLAT, you're buying the life insurance on the citizen spouse to benefit the non-citizen spouse and children. So if I were the citizen spouse, you'd buy the life insurance on me, and it's going to go to my non-citizen spouse, wife, and the children. The death benefit is still going to be income tax free. There's still cash values available to them, and even an independent trustee, it can be typically used. So here we have an example of a husband and wife. The husband is a U.S. citizen. The wife is a non-U.S. citizen, so she's an alien. Typically, it's a resident alien. You can see they have a couple of kids, and we do this SLAT as an alternative to the QDOT. And what allows this to happen is that the trust distributions can go to the wife while she's alive, subject to this ascertainable standard: health, education, maintenance, and support. So she could get to the money inside of the SLAT. Even the life insurance values, if she needed to, she could have access to that. And of course, when she dies, after her husband died first, then that SLAT, if it's funded with a survivorship policy, the money will go to the trust and to the kids. If it's funded with a single life policy on the husband, the death benefit goes into the trust, and then that trust can distribute that money to the wife and or the kids under the HEMS standard for the wife. And then, of course, the children are just the normal trust beneficiaries, so they would have that like you would have it as any or other trust. So it's just something to think about when you're thinking about, well, how do I get this life insurance? How should it be owned? Well, if it's the case of a U.S. citizen married to a non-U.S. citizen, particularly a resident alien, this SLAT can come into play as well.
That's great.
So we're just going to wrap up real quick. We're going to talk a little bit about the non-resident alien. I mentioned that the life insurance is excluded from the non-resident's estate under Section 2105. The proceeds from the policy that are owned by the non-resident alien are, I mentioned, federal income income tax-free and estate tax-free. You might be wondering about the cash values. I alluded to the cash values before. The cash values grow tax-deferred, just like the kind that you and I have, income tax-free. And the tax-free cash values through loans and withdrawals. So the non-resident alien could own a LIRP, for example, and they wanted to get that income there. So that's kind of nice as well. And then, of course, I said the death benefit is not subject to U.S. income tax or surrender. Now, if they surrender it, there could be a tax gain, and that would be true even if it was a U.S. citizen, because as you know, whenever a U.S. citizen or policy owner surrenders a policy, there could be taxes if there is gain in the policy. So, and from that standpoint, there isn't much different because a surrender or a lapse could be subject to U.S. income tax. So with that, Kurt, I just wanted to wrap up with one final example. We got John. He's a U.S. citizen. He owns assets in the U.S. and in Chile. It looks like John is a successful executive, and his worldwide assets may be subject to U.S. federal estate tax. So John probably owns property in the U.S. You know, he has a home here. Maybe he's married. Maybe he has children. But he maybe has his family home that he inherited from his parents that are in Chile. You have Anna. She's an Australian citizen. She's based in Australia, but she comes to the U.S. a lot for work, for vacation, friends, college friends. But she decided, you know, I'm going to own some property in the U.S. I love the U.S. and I want to own some property in the U.S. So her assets in the U.S. may be subject to U.S. federal estate taxes. And then lastly, we've got Kevin and Michelle. They're a married couple. They're residents of the U.S. Kevin is a U.S. citizen. His wife, Michelle, is a non-U.S. citizen. So as residents of the U.S., they may be subject to U.S. federal estate tax, but how their assets are treated will be different from John or Anna. Because remember, John is a U.S. citizen, so he gets all the benefits that a U.S. citizen. Michelle, being a non-U.S. citizen or a non-resident alien, she gets many of them, but not exactly the same. So that's why it's important to know those differences. So with that, Kurt, I thought I might stop and turn things back over to you.
Well, thank you. That was very enlightening. And the thing I love is we continue to talk about markets that potentially are overlooked. And hopefully some of you today, as you were listening to this, took time to write down, boy, you know, I do know somebody either at the club or in town or in the neighborhood that maybe I should talk to them. And the thing I want to make sure you feel empowered with is this. DBS has the resources between our advanced marketing team with Terry Getman, partnering with our partners at Prudential, as well as making sure that we are also synced up to our regional sales directors. All of them working in concert can help you. So look, I don't expect that every single one of you would be able to give the presentation that we just saw. I'm not sure I could. I don't have a law degree. However, know that we've got the experts that are here to help you to make sure that your cases can come through successfully, and we can help you bring the solutions to your clients that your clients need, because as you heard many times, they have the same needs that you and I have, and we're here to help. Any final words for our audience today?
Well, I'll say, Kurt, thank you so much for inviting me. As you said, and I'll reiterate it, this is a great opportunity. They're right in our backyard. They're in our neighborhoods. And so let's work with DBS to see if we can penetrate this market and increase the sales that we have to non-resident and resident aliens.
That sounds great. Well, hey, everybody out there, thank you so much for taking time out of your schedule to join us for another edition of Sales Accelerators. I look forward to seeing you next time. And until then, be well, stay safe. We'll talk to you real soon. Take care, everybody.